Hello, my name is William Burrows, founder of the Retirement Project. Today I'm talking about pension drawdown. We'll have a quick overview, look at the income options, investment options, what happens on death, tax on income payments, and the risks. So let's get started. Pension drawdown is relatively straightforward to understand, but complex to manage in practice. Most drawdowns are set up as part of a self-invested personal pension SIPP, and that means that you can normally take 25% cash up front. The money is then invested, and you've got a wide range of investment options. The next thing is quite important because with drawdown you can take income. You don't have to take income. You can have what's called a NID, no income drawdown. More of that later on. You can take regular income in the same way that you would get regular income from an annuity or from a pension scheme, or you can just simply take ad hoc payments. The most important option for most people are what happens on death. If you fall under the bus with a pension drawdown plan, the money can be left to your beneficiaries, and that they have a number of choices, but basically they can take the money as a lump sum, but that's taxable, so perhaps not advisable. Your beneficiaries can continue with drawdown in what's called a dependence drawdown, or they can buy a dependence annuity. The tax on this is quite important. If you fall under the bus before age 75, there's no tax on any payments taken out by beneficiaries. But if you die after the age of 75, any monies taken out by beneficiaries will be taxed at their marginal rate. Something that's happened quite recently and has got a lot of attention in the press is that from 2027, unused pension pots will be included in your estate and hence in IHT calculations. So let's look at the income options. As I've said before, you can take anything from 0 to 100%, and I'll keep repeating, all income is taxed at your marginal rate. NIDs are really useful for people who just want the maximum tax-free cash but no income. So say you've got £100,000 pension pot, you might say, I'll take my £25,000, the balance 75,000 can remain invested, and then sometime in the future I'll take an income or perhaps even buy an annuity. Traditionally, drawdown has been associated with taking a regular income in much the same way as you would take an income from an annuity or from a pension scheme. And there's a term called sustainable income. And a sustainable income is an income that will increase in line with inflation, but hopefully not run out of money in the long term. You might have heard of the 4% rule. Some academics in America came up with a concept of if you take 4% rising with inflation from your pension pot, that probably should be sustainable in the long term. But nowadays, with low interest rates and volatile stock markets, the sustainable income rate is more like 3.5%. But I'll hopefully do a video on that in the future. Some people simply take ad hoc payments. I have clients who come to me and say, I'd like £5,000 or £10,000, and that can be arranged, but of course, all payments are taxable. Investment options. This is what makes drawdown so complicated, because if you invest in an annuity, your money is in secure assets. But with drawdown, you invest the money in a pension fund. I think basically there are three ways to invest. Some people choose to self-select, and obviously Hargreaves and Interactive Investor are good examples of that. You can put your money in direct equities, bonds and funds. Personally, I have a little bit of a problem with that because I would say this: you would benefit from advice if you have a large pension pot. What's a large pension pot? Perhaps £1 million. You can go to a DFM, a discretionary fund manager. They will invest your pension pot in a broad range of direct equities, bonds, funds, and one of the unique features of DFMs is that they can access what they call alternative investments. But I won't go into that today. And if you come to me, what I call the advisor options, as an advisor, there are a number of things we can do, and obviously the money is invested in relation to your personal risk profile and future income withdrawals. We can invest via managed portfolio services, MPS model portfolios, multi-assets. We can go into direct funds. The smooth return funds are quite popular, or a combination of the above. What happens on death? This is really important because this is, for most people, the biggest attraction of Drawdown. So after death, the remaining funds can be inherited by chosen beneficiaries. They can take a lump sum payment, as I said before, and that's taxable. Dependence drawdown. But basically, if your spouse or partner can metaphorically step into your shoes and continue taking an income from the pension pot, a dependence annuity. Since pension freedoms, the definition of beneficiaries has been expanded, so it can include family members such as spouses, partners, children, grandchildren, as well as friends or charities. I have a number of clients who don't have children, and they plan to leave their pension pots to charity. Let's talk tax. Income tax is straightforward. Think about it as being like PAYE. Pension provider applies to HMRC for a tax code, and then they will deduct the appropriate amount of tax at source. If you die before age 75, there's no tax implications for beneficiaries because any payouts, whether it's lump sum or income, are tax-free. But if you fall under the bus after the age of 75, your beneficiaries will pay tax at their marginal rate on any income or lump sum payments. The big talking point at the moment is IHT. From 2027, unused pension pots and death benefits will form part of your estate and may be liable to IHT. My personal view is that this may be overblown. Most people with modest pension pots will now be encouraged to take income from their pension pots to help fund their income requirements in retirement. But those with bigger pension pots will definitely need to take specialist advice on IHT. I'll maybe do a video on this sometime in the future. Risks. The most obvious risk is the investment risk, but it's not just the normal risk. If you are young, saving up, in your 40s, 50s, and if there's a stock market crash, time is on your side, and hopefully the markets will return to the normal returns and catch up. But at retirement, time isn't on your side, especially if you're taking income. So there's a particular risk which we call sequencer of returns risk. Put simply, if you invest your £100,000 and you're taking, say, 4% income, but there's a 10% reduction in the value because the stock market's fallen, then it means that you're taking 4% out of a reduced pension pot. It's going to take quite a while for the pension pot to return to its previous value. So that's the sequence of returns risk. Income risk, there's a risk that you may get less income than expected. The biggest risk, and this links with sequence of returns, that if you have a bad run of returns and you take out a lot of money, you could simply run out of money. Of course, the advantage of an annuity is that you'll never run out of money because it's income for life. Um, and there's a phrase that I use, and obviously, I'm known for, my advice on annuities. There's a mistaken belief that you can get the same outcome from drawdown as you can compared to an annuity. So, put it simply, drawdown is very attractive because it's got flexibility and death benefits, but it does come with risks. Despite the risks, there are a lot of advantages for drawdown. In fact, you can say since pension freedoms, drawdown has become the default option as opposed to annuities. Why is that? Income flexibility. You can tailor income to your personal requirements. Investment control, wide range of investment options. Conventional investment theory says that in the long term, equities are a really good investment and will outperform other asset classes. But you've got to be careful because we live in a very challenging, volatile, and uncertain world. So take care with the investments. And of course, for most people, the big advantage are death benefits. If you have an annuity on death or death of the partner, income stops, but with drawdown on death, you do have the option to leave unused pension pots to beneficiaries, but watch out for the IHT. So that's all for now. Thank you for listening. Any questions, please email me or contact me through the website. Thanks and goodbye.